Right before the coronavirus stock market crash of 2020, Tesla's stock price had a absurd run and reached a staggering price of around $900 per share. And as the stock market started to crumble beneath itself, Tesla's stock price crashed from $917 to just about $350, represents over a 50% decline in the stock price in just 1 month's time. Now, just to give you a little bit of background about myself, since December of 2016, I have been working on my own trying to start an online business, which morphed into a YouTube channel. And these days, I'm focused 100% on YouTube. And my first channel, or my main channel, I should say, is called Project Option. And naturally, after I quit my job to start this online business, I did not have a lot of money coming into my pockets every month. In fact, I had very little coming into my pockets every month. And because of that, I could not invest any money whatsoever into stocks. But fortunately, 3 years later, my business, or the YouTube channel, has been growing exponentially, and fortunately I have some free cash flow that I can invest into stocks, which led me to start investing and researching different companies to invest in for my future. A couple of months ago, I made a video called 9 Growth Stocks for 2020 and Beyond, and naturally, one of the stocks that I discussed in that video was Tesla. And at the time of recording that video, Tesla's stock price was around $700 per share, which is also the same, or about the same price that I paid for my shares of Tesla at that time. And I had mentioned that I thought Tesla was a good long-term investment over the next 5 to 10 years. And I still stand by that statement. But with Tesla having the following that it has, and the fear of missing out investors piling in, and the shorts getting squeezed out, Tesla's stock price has more than doubled since I made that video called 9 Growth Stocks for 2020 and Beyond, which was just a few months ago. Now, this might sound strange to you, but even as a Tesla investor, someone who owns shares of Tesla stock, obviously I want to see the stock price increase because my investment will grow. And the number one goal of investing is to grow your money. But even as somebody who owns shares of Tesla, I do not think that this recent rally is completely justified, and because of that, I think Tesla is currently overvalued, at least in the short term. But I'm not selling my shares, and let me explain why. With the advancements in brokerage firm technology and the subsequent reduction in costs and fees associated with making trades in the financial markets, it's gotten extremely easy and almost or virtually free for investors to buy or sell shares of stock and to enter and exit their positions, which is both a very good thing for individual investors, but it's also a bad thing. With the ease of investing in the financial markets these days, it's all too easy to make impulsive decisions with your investments. If you buy shares of a company's stock for the long term, then just because the stock price goes up, it does not mean that you should close your position. And as an investor, you have to understand that stock prices will go up, stock prices will go down, and occasionally you may not agree with the magnitude of the stock price movement that you see, even if it is something that you are invested in. So in this case, I am an owner of Tesla shares, but I don't necessarily agree with how much the stock price has increased in recent months. As a long-term investor in Tesla and someone who has basically just gotten started with building an investment portfolio, since I could not the previous years because I wasn't making enough money, I want to continue building my position in Tesla and many other companies that I like for the next 5 to 10 years or even longer. And because of that, I have a buy-only mindset. And what that means is that when I buy shares of stock, I am not anticipating or planning to sell those shares of stock anytime soon, at least within the first year. And because of that, my mindset is to purchase shares of stock, and then every single month as I have more money to invest, purchase more and more. And this way I will grow an investment portfolio over the long term, and I'm not concerning myself with trying to time the bottoms and the tops of short-term stock price movements, which is not investing, that is called trading. And it is important to draw the line between trading and investing. It's completely fine if you want to be active and trade some things, as I do. My first channel is for options trading, and I do use options in my portfolio, but I understand the difference between an options trade, which is short-term in nature, and a long-term investment in a company. Another reason I don't want to sell my shares of stock is that it would create a taxable event. And since I only purchased these shares of stock in Tesla a few months ago, if I sold the shares right now and secured my gains, those realized gains would fall under short-term capital gains taxes. And short-term capital gains, meaning any gains that you've realized with a holding period of less than 1 year, those taxes are going to be your ordinary income tax rate, which are going to be much higher than the long-term capital gains tax rate. So as I record this video, the long-term capital gains tax rate is between 0 and 15%, depending on how much your income is. And basically what that means is that if you hold an investment for longer than 1 year and you sell that investment for a profit, you are taxed on those gains at the lower long-term capital gains tax rate, as opposed to the short-term capital gains tax rate, which is going to be your ordinary income rate. And that's going to be higher than 0 to 15% in a lot of cases. So the real point of this video is to just bring up the fact that as a long-term stock market investor, there are going to be times when you invest in something and you may not agree with the stock price movement that happens in the short term. And when that happens, you should not be impulsive with your decisions and make more and more trades and try to be more of a stock market timer, but you should understand that when you invested in that company, you had a long-term mindset and you should stick to that mindset, because after all, if you abandon your long-term mindset, then you're going to be turning your investing into trading, and they are not the same thing. So it's completely fine to be a short-term trader or a long-term investor, or both, as I consider myself to be, but recently, and with how easy it has become to actually transact in the financial markets, I think one thing that's being overlooked right now in terms of long-term investing is that it's very easy to make impulsive decisions these days, because you can get in and out of your positions in the blink of an eye and without paying virtually anything in fees. And because of that, I think there's a tendency to be a little bit too active when it comes to long-term investing. That's going to be it for this video, everybody. I hope you enjoyed it. I understand if some of you may disagree with my takes in this video, and that's completely fine. We're all entitled to our own opinions. But the point of this video was just to say that when you are investing in stocks, sometimes you may not always agree with the movement in that stock, even if it is beneficial to you, as it is in my case, since I purchased shares of Tesla a few months ago and they've already doubled in value. But personally, and as I've mentioned in this video, I don't think that that move is completely justified. I think it is mainly due to FOMO investing and short squeezes, and I am focused on the long term for Tesla, and I'm hoping that we get a pullback in the shares so that I can continue to build my position without paying $1,500 a share, which is 100% higher than I paid just a few months back. So I hope this video is helpful and that you enjoyed it. My name is Chris Butler, and I will see you in the next video.